Right now, there is growing discussion around crypto regulation in the United States, and one topic is starting to get serious attention: whether certain digital assets like XRP could face restrictions for everyday retail investors. At the same time, there are talks and rumors connected to the Federal Reserve and large financial institutions exploring high-value digital transaction systems, including figures like $10,000 limits or thresholds. This has created confusion, fear, and also opportunity in the market. Many XRP holders are asking one big question: is this the beginning of a system where retail investors are pushed out while institutions take control? In today's breakdown, we're going to look at what this USA ban on XRP for retail really means, where this $10,000 Federal Reserve proposal idea is coming from, and why this situation could be much bigger than most people think. Because if you look deeper, this is not just about XRP. This is about control, access, and who gets to benefit from the next financial system. While big institutions continue buying behind the scenes, retail investors are locked out. And at the same time, a system is being built where transactions above $10,000 are tracked, controlled, and possibly even restricted. Sounds crazy, right? But what if I told you the signs are already here and most people are completely ignoring them? Stay with me, because what we're about to uncover could change how you look at XRP forever. Welcome back to XRP on Moon, your go-to place for the latest XRP updates, big insights, and what really matters for holders like you. If you want to stay ahead in this fast-changing crypto space, make sure you're paying close attention to what's happening right now. Let's break this down step by step. First, the idea of the United States banning XRP for retail investors is not something officially confirmed, but it is coming from growing regulatory pressure and patterns we've already seen before. Think about how governments have approached crypto in the past. They often start by saying they want to protect investors, but slowly introduce rules that limit access. We've already seen lawsuits, restrictions on exchanges, and strict rules around who can buy what. And XRP has been at the center of one of the biggest legal battles in crypto history. That alone makes it a target for tighter control compared to other coins. Now here's where things get interesting. While retail investors face uncertainty, large financial institutions are moving in the opposite direction. They are building systems, partnerships, and infrastructure that look very similar to what XRP was designed for: fast, low-cost global payments. This creates a strange situation. On one side, retail investors are dealing with fear and confusion. On the other side, institutions are quietly preparing for large-scale adoption. And when you combine this with discussions around transaction monitoring, especially amounts like $10,000, it starts to look like a system where every move is tracked and possibly controlled. So what does this $10,000 proposal really mean? In simple terms, it connects to financial reporting rules. In the traditional system, transactions above certain amounts are often flagged or reported. Now imagine bringing that same idea into digital assets, where every transaction is already recorded on a ledger. If new rules are applied, it could mean tighter control over how people use crypto, especially for everyday investors, and if XRP becomes part of a regulated financial network, access might not be as open as it is today. This is where the real question begins. Is this about banning XRP, or is it about controlling who gets to use it? Because history shows us something important. When a new financial system is being built, early access is rarely given to everyone equally. There are phases, and sometimes retail investors are the last to benefit. And if that's the case, then what we're seeing right now might not be random at all. It could be part of a much bigger shift that is slowly unfolding right in front of us. To understand what is really happening with XRP and the idea of retail restrictions in the United States, we need to slow down and look at the bigger financial system, because nothing in crypto exists in isolation, especially when governments and central banks are involved. The discussion around XRP being banned for retail is not something that appears out of nowhere. It usually comes from a combination of regulatory pressure, compliance frameworks, and the natural direction of how financial systems evolve when they start integrating digital assets. In simple terms, when something becomes powerful enough to affect global payments, it also becomes something that authorities want to control more tightly rather than leave fully open to everyone without limits. Right now, XRP sits in a very unique position compared to most cryptocurrencies, because it is not just being treated as a speculative asset, but as a potential bridge between traditional banking and blockchain-based settlement systems. This is exactly why it has been under regulatory scrutiny for years, and why every new policy discussion in the United States tends to bring XRP back into the spotlight. When people hear words like restriction or ban for retail, it creates fear. But in reality, most of these ideas come from how financial compliance works in traditional banking, where not every product is accessible to every type of user without verification, licensing, or institutional approval. At the same time, there is another layer developing underneath all of this, and that is the growing conversation around large value digital transactions, including the idea of thresholds like $10,000 or higher being monitored more strictly within digital financial systems. This is not specific to XRP alone, but it becomes relevant when people connect it to Ripple's technology because XRP is designed for fast, large-scale settlement between financial entities. So when policymakers talk about transaction monitoring, reporting requirements, or digital asset oversight, XRP naturally becomes part of that conversation, whether directly or indirectly. Now, what makes this situation more intense for retail investors is the feeling that they might be left behind while institutions move forward. This is not a new pattern in financial history. In many major transitions, early infrastructure development is usually handled by large institutions, banks, and regulatory bodies before retail participation becomes fully integrated. During this phase, retail investors often experience uncertainty because rules are still forming, narratives are changing, and access can feel unstable or unclear. That is exactly the type of environment XRP is currently sitting in, where long-term potential exists, but short-term clarity is still developing. However, it is also important to understand that the word ban is often misunderstood in crypto discussions. In most cases, governments do not completely eliminate access to an asset that already exists globally on decentralized networks. Instead, what usually happens is restriction of certain access points, such as exchanges, banking rails, or retail investment pathways. This means that even if strict regulations come, it does not necessarily mean XRP disappears from the system, but rather that how people interact with it could change significantly depending on compliance rules and financial licensing structures. So when we connect all these pieces together, the conversation is not just about XRP being banned or allowed, but about how it fits into a future financial system that is becoming more structured, more regulated, and more institutionally driven. It becomes even more important to separate emotional reactions from actual structural changes happening inside the financial system. Because when people hear phrases like XRP ban for retail or Federal Reserve $10,000 proposal, the immediate response is usually fear or excitement, but the real story is more about how financial control systems are slowly being redesigned for a digital future. In this phase of transition, governments and central banks are not simply reacting to crypto, they are actively studying how it can be integrated into existing monetary systems without losing regulatory oversight. And this is where XRP often enters the discussion due to its design for fast settlement and institutional use cases. One key point that many retail investors overlook is that financial systems are built in layers, and each layer serves a different purpose, with retail access usually sitting on top of institutional infrastructure. This means that before any asset becomes widely available for public use in a fully regulated environment, it often goes through a phase where institutions test, integrate, and adapt the technology within controlled frameworks. XRP, because of its focus on cross-border payments and liquidity solutions, naturally aligns with this kind of institutional testing environment, which is why it continues to appear in conversations involving banks, payment networks, and even central bank digital currency discussions. Now, when we bring in the idea of a $10,000 threshold or proposal linked to Federal Reserve-style monitoring, it is not necessarily about setting a price for XRP, but more about transaction oversight and financial reporting systems that could apply to large digital transfers. In traditional banking, large transactions are already monitored under anti-money laundering rules. And as digital assets become more integrated into the financial system, similar frameworks are expected to be extended into crypto markets. This does not automatically mean restrictions for retail investors, but it does suggest that the environment will become more structured, with clearer rules about how money moves across digital networks. At the same time, there is a growing concern among retail participants that such regulatory developments could indirectly limit their participation in assets like XRP, especially if access is controlled through licensed platforms or institutional gateways. This is where confusion often builds, because regulation does not always mean banning an asset, but it can mean changing how people are allowed to interact with it. For example, if XRP becomes deeply integrated into banking infrastructure, retail exposure might depend heavily on regulated intermediaries rather than direct, unrestricted access as seen in the early stages of crypto markets. What makes this situation even more significant is the speed at which financial systems are evolving compared to public understanding. While institutions and regulators are actively working on frameworks for digital settlement, many retail investors are still viewing XRP through the lens of short-term price movement rather than long-term infrastructure development. This gap in understanding creates uncertainty, especially when new policy discussions surface, because people interpret structural changes as immediate threats rather than gradual system upgrades. So as we look at the bigger picture, it becomes clear that the conversation is not simply about whether XRP will be banned or allowed for retail users, but about how access, control, and integration will be distributed in a future financial system that is becoming increasingly digital, regulated, and institution-driven. And in that environment, the role of XRP is not just as a tradable asset, but as a potential settlement layer that may operate under rules very different from what retail investors are currently used to, which is why every new regulatory signal creates so much attention and speculation in the market. It becomes clear that the real discussion around XRP is not just about regulation or speculation, but about how financial power is being reshaped in real time, and how that reshaping naturally creates uncertainty for retail investors who are trying to understand where they fit in this evolving structure. When governments and central banks begin exploring digital settlement systems, they are not only thinking about innovation, but also about control, stability, and risk management, which means every asset that has the potential to move large amounts of value quickly will automatically fall under closer observation and structured oversight. This is where XRP continues to stand out because its design is not based on slow retail speculation cycles, but on fast institutional-grade transactions that are meant to replace or improve existing cross-border payment systems. When you place that kind of technology inside a regulated financial environment, it naturally attracts discussions about compliance, access rules, and usage limitations, especially when it is being considered alongside central bank digital currency frameworks and interbank settlement systems. So the idea of retail restriction is often less about banning the asset itself and more about controlling the pathways through which different types of users can access and utilize it. At the same time, the broader financial system is also moving toward more transparent tracking and reporting mechanisms, especially for high-value digital transfers. And this is where concepts like a $10,000 threshold or monitoring proposal become relevant in discussion. In traditional finance, these kinds of rules already exist to prevent illegal activity and ensure accountability. But when you transfer that logic into a blockchain-based environment, where transactions are already permanently recorded, the focus shifts from hiding activity to categorizing and regulating it more efficiently. This means that future systems could potentially differentiate between retail-level activity and institutional-level liquidity flows in a much more structured way than today. For retail investors, this creates a psychological gap because on one hand, they see a decentralized asset that can be freely traded, and on the other hand, they see increasing signs of institutional adoption and regulatory tightening. This dual narrative often leads to confusion because people assume that increased regulation automatically equals exclusion, when in reality it often means integration into a more formal financial framework. However, the concern remains valid that early-stage access can change, especially if trading routes or on-ramps become more controlled through licensed financial institutions or regulated platforms. Another important aspect to understand is that financial transitions of this scale never happen instantly. They move in phases where experimentation comes first, then institutional adoption, and finally broader public integration once the system is stable and fully regulated. XRP appears to be positioned in the middle of this transition phase, where institutions are increasingly interested in its utility, while retail investors are still operating in a market environment that feels speculative and uncertain. This mismatch between institutional progress and retail perception is one of the main reasons why rumors, fear, and speculation tend to grow rapidly around topics like bans or restrictions. So when we connect all of this together, the situation is not as simple as XRP being allowed or banned for retail users, but rather about how financial access itself is being redesigned for a future where digital assets are part of regulated global infrastructure. And in that future, the rules of participation may look very different from today, not necessarily removing retail involvement, but reshaping how, when, and through which channels that involvement is allowed, especially as governments continue building frameworks that merge traditional finance with blockchain-based systems. It is important to bring everything together and look at the situation in a clear and balanced way, because the discussion around a possible XRP retail ban in the United States and the idea of Federal Reserve level proposals like $10,000 monitoring thresholds is not just about headlines, but about a deeper shift in how money, regulation, and digital assets may work together in the future. When you step back and analyze it properly, what we are really seeing is not a simple yes or no situation, but a gradual transformation of the entire financial system into something more structured, more monitored, and more institutionally controlled than what most retail investors are currently used to. The fear of retail restriction often comes from misunderstanding how regulation actually evolves. In most cases, governments do not completely remove access to a financial asset that already exists globally, especially when that asset operates on decentralized infrastructure. Instead, what typically changes is the access layer, meaning how people are allowed to buy, hold, trade, or interact with that asset through regulated platforms. This is where XRP becomes a central topic because if it continues moving toward institutional adoption and integration with banking systems, then retail access may increasingly depend on compliance frameworks, licensed intermediaries, and regulated financial gateways rather than completely open and unregulated markets. At the same time, the idea of large-scale transaction monitoring, including thresholds like $10,000, reflects a broader global trend toward financial transparency and risk control, especially as digital transactions become more common and more complex. This does not automatically mean XRP is being targeted specifically, but it does mean that any asset capable of moving high-value liquidity quickly across borders will likely be included in future oversight systems. In such a system, XRP's role could become more important for settlement efficiency, but also more regulated in terms of who can use it and under what conditions. What retail investors need to understand is that this type of evolution is not unusual in financial history. Every major shift in the monetary system has gone through a phase where early infrastructure is dominated by institutions, while retail participation becomes more structured over time. During this phase, uncertainty is normal, and so is speculation. That is why rumors about bans or restrictions tend to circulate strongly, because people are trying to interpret long-term structural changes using short-term market emotions. However, the reality is that integration does not always mean exclusion. It often means transformation of access rules rather than complete removal of participation. Looking forward, the most important thing to watch is not just price movement or headlines, but how XRP continues to position itself within institutional frameworks, banking partnerships, and regulatory discussions, because those are the factors that will determine its long-term role in the global financial system. If adoption continues, XRP could become part of the underlying infrastructure of cross-border payments, which would naturally bring it under stricter regulatory oversight, but also potentially increase its importance in global liquidity movement. So the final takeaway is simple but powerful. The conversation is not just about whether XRP will be banned for retail or whether a $10,000 Federal Reserve proposal will directly impact it, but about how the entire financial system is transitioning into a more controlled digital environment where access, compliance, and institutional integration will play a major role. For retail investors, this means staying aware, staying informed, and understanding that the rules of the game are changing, not necessarily disappearing. And in the middle of that change, XRP continues to sit at one of the most important intersections between traditional finance and the future of digital money. This content is for educational and informational purposes only, and should not be considered financial, investment, or trading advice. Cryptocurrency markets are highly volatile and risky. Always do your own research and consult a qualified financial advisor before making any investment decisions. If you enjoyed this breakdown, don't forget to like, subscribe, and comment your thoughts on XRP On Moon.